Hey, it's Conrad the Mortgage Guy, and you're listening to Have More Money Now. And of course, we couldn't do it without our very gracious host, Hall of Famer, former world champion, ladies and gentlemen, Mr. John Layfield. John, how are you, man?
I'm doing outstanding, Conrad, and I think the term is probably co-host because you have been incredibly successful in your own right. So I think it's co-host is what the correct term is.
Well, we're just great to be under your learning tree today. We are enjoying our run here on Have More Money Now. If you haven't already, I encourage you to check out our debut episode. We broke down John's entire story and how he got into investing, what some of his strategies have been, what some of his best practices have been, and then he even opened up his portfolio and showed us what his real returns have been. So if you're curious on how to get started, I encourage you to check out the archive starting with episode 1. But here we are on our follow-up effort, and boy, it feels like every day there's new news in the financial markets. I think the biggest story over the last week or so has been what's going on with Bitcoin. We talked a little bit about Bitcoin last week, but John, do you have a handle on what's happening with Bitcoin right now, and where do you think this winds up?
I think people are just trying to find value right now. People are very, I think, confused as to what, because not many times in geopolitics has it had affected so much the global economy as to right now. So you've got President Trump, right or wrong, with the deglobalization going on globally right now. You've got trade deals being made that are landmark trade deals. You've got India and China and Russia getting together for the first time. Now, there's a chance you're going to have what they call the petro yuan, which is what China was trying to do to take the dollar out of being the reserve currency. That's a huge deal. They might get some traction with that now because you're seeing these guys forced together. So you're seeing Russia, China, and India, groups that generally do not like each other historically, working together for trade deals. Same thing with EU, same thing with Canada. And so you're seeing a global shakeup right now. And I think people are just simply trying to find that barometer of where value is. And Bitcoin sure fits into that. Bitcoin and the whole cryptocurrency market fits into that because it's a store of value. And so you're trying to figure out where this value should be. The same thing with gold, with silver. You've seen a huge decline. You've seen some retracing of the steps. It's still at an incredible all-time high. But I think people are just trying to find value right now in the world.
I love that we're able to talk about Bitcoin here today. I'll admit I have not been a big crypto dude, but even as we're recording this morning, it's down 3.67%. You know, if you take a look over the last 5 days, because when we last recorded last week's episode, it felt like on the heels of that, there was a little bit of a rally. And then, well, it's back where it was. Over the last 5 days, it's down 6%. Over the last 30 days, it's down 26%. Over the last 6 months, it's down 46%. If any of our listeners are holding Bitcoin, and I know that this is very subjective and this is probably outside of your wheelhouse, but last week you sort of explained that, hey, you shouldn't be checking your stocks every single day. I mean, it's hard not to do that, but you drive yourself crazy with that. You need to look at this over the long haul. And I know, for instance, you know, we've seen some posts on X where there was a guy who had been buying $30 of Bitcoin for 7 years, 10 months, and 12 days. So he made it into $1 million portfolio, and his only out of pocket was around $86,000. So he's invested $86,000 over the last 7 years, 10 months, and 12 days, and now it's worth $1 million. So over the long haul, my man got quite a return on his Bitcoin investment. But now I'm wondering, is this where the rubber meets the road? What would your advice be? And again, this isn't advice for everyone, but if you had money in Bitcoin, John, would you be skittish about pulling it out right now? Would you try to ride it out? What would be the best practice for
I would take profit on this. I would take profit on anything that's gone up this much, not just because it's Bitcoin or not just because of any geopolitics that are being involved around crypto coin. But if you have something that goes up this much, you put $86,000 in something total. Now, your dollar cost averaging, which is a really smart way to do. Dollar cost averaging is simply just putting money in at a certain time, the same amount of money. So you dollar cost average what your investment is. And if you have $86,000 turns into $1 million, you've got 11 or 12 times return. I don't see how you don't take some profit off the table here and just guarantee you, like, at least get your $86,000 back. Sell 1/10 of it. And you have $100,000. You have a $14,000 profit. Then the other $900,000 you can let ride. You can figure out when you want to trade it or not, if you want to trade it, or you can sell part of it. But there's nothing wrong ever when you have a huge run up like this, taking some profit, pulling it back in, guaranteeing that you've made some money off this, and then looking to see why this thing is having such volatility after you've got that profit in your pocket, so to speak.
What about for the folks who bought it higher and now they've taken a loss? Do you think that you have to have, I think the kids are calling it diamond hands and hang on to it, or is it time to cut bait and move on? Do you think if you're showing a loss right now in Bitcoin, does that change your advice?
No, not unless something fundamentally has changed. So if you bought this at whatever the valuation is, say you bought it at 20% higher than now, if you still believe in why you bought it, then there's no reason to sell it. Unless something has fundamentally changed. Has crypto been banned somewhere, say in the EU or in China or in parts of Asia or somewhere else around the world, and things are materially changing? Yes, that's a reason to get out, or at least to pull back and see what's going on. But unless nothing has fundamentally changed, it's like buying a company. And you buy a company and say that you buy it for $100, and you can't buy a company for $100, but that's an easy number. You buy a company for $100, you think you got a great CEO, you got a great product. All of a sudden that company goes down to $80. Now, is that the same company? Yes. The market just says it's worth less, but your investment thesis has not changed. If your investment thesis is that strong, I'd buy a little bit more. It depends on if you have money and that available to buy, of course, and what your personal finance outlook looks like. But unless things have fundamentally changed, I wouldn't change your views just because a price has gone up or a price has gone down.
Well, there you go. I'm interested to see how Bitcoin continues to evolve and what changes we may see. I want to transition to a headline that really caught my eye about retirement. Now, this came out last week, but CBS News reported on Money Watch, and what a headline this was. The typical U.S. worker has $955 saved for retirement. Now, of course, they're saying this figure factors in workers with 401k and other retirement plans. So I guess there's 56 million U.S. workers who lack access to employer-sponsored retirement. But even those who do have retirement, the median balance stands around $40,000. And CBS says that's a far cry from the roughly 1.5 million that Americans say they will need to retire comfortably. You know, and that's really what we're trying to do on this show is set people up to think about what the end of their life looks like. I think a lot of people get caught up in the here and now. And when I hear that, you know, most American workers only have $955 saved for retirement, that's what it feels like. We're living in the here and now. Maybe we don't have a long-term plan. I know you teased it last week about Warren Buffett's claim that compound interest is the greatest invention ever, and that's hard to argue. But when you hear that the average worker has $955 or even $40,000. What it sounds like to me, John, is they just didn't start soon enough. Do I have that right?
Yeah, you have that right. And another thing you have is, look, you're not a screw up. There are a lot of people out there that say, man, if you only have $955, which is an average, you quote from this article, which I'm sure is right. Look, did you screw up? Yeah. But does that make you bad? Absolutely not. It makes you normal. A lot of people, people don't plan for retirement because they plan on working forever, or they plan on hitting it big. They think, within 10 years, I'm going to be making a lot more money, or within 5 years, I'm making a lot more money. The best thing in the world was in WWE. Nearly everybody was, I'm just going to do it for 3 to 5 more years. No matter where you were in your career arc, that was always the comment that people would make. I'm just going to do it for 3 to 5 more years. People feel the same way about retirement. Like, in 5 or 10 years, I'm going to start making more money. I'll start saving then. You got to start saving now. But the one thing this tells you is that you're not alone, right? And you're nothing wrong with you. You're pretty normal if you don't have much retirement. It's not a big deal. That's life. And that's what most people do. But you got to start saving. We're in a time right now, Conrad, that is one of the greatest times in the history of mankind. And I think one of the technological advances that are going to happen right now in mankind are going to be the biggest in the history of the globe, bigger than the internet, bigger than industrialization. This AI, I mean, we're going to have, talking about 2027, we're going to start having a moon base, according to Elon Musk. He always a little bit too optimistic sometimes on his projections, but say it's done by the end of the decade. That's huge. We're going to have people living on different planets in this decade. It certainly looks like. This is the time that the whole world is changing. It's a perfect time to get investing. Start investing in something. Invest in it with the dollar cost averaging, where you invest so much every month. Put it in something. You're going to be doing quite well in 20 to 30 years.
Well, and we know that it's kind of a damned if you do, damned if you don't time for a lot of folks. There's another report from CBS in the last week that says that credit card balances have risen by $44 billion. So while America has less than ever before, say for retirement, we seemingly have racked up more than ever with the credit card debt. And I know that, the theme of our show is have more money now. And I think a lot of people tune in for investment advice, and we're going to continue to share some of John's best practices. But really, before you can start adding to, you've got to figure out what's taking away and what's eating into a lot of folks' P&L every month. And they may not even realize it is the credit card debt, because it doesn't seem like a big deal. Hey, we'll just put dinner on the old credit card. But what you wind up doing is you put a $200 night out onto a credit card, and you wind up paying $25 a month for it with interest on top. I think the average interest rate right now on credit cards is hovering north of 20%, which is just a real head scratcher. I mean, if I full time am in the mortgage biz, and if all of a sudden my rates were 20%, no one would call. But if I disguised it as a credit card, boy, they just line up seemingly. And I think there's a bit of a mentality shift where people are really rate conscious in some areas of their life. They'll shop forever to make sure they've got the best possible interest rate on their home loan or on their car loan. But a lot of folks are carrying enough credit card debt right now, John, that it almost feels like they have another car payment, except not at, whatever the prevailing rates of today may be, 4, 5, 6, 7%, but a multiple of that. Step one to really having more money now, before you even get serious about investing, is eliminating the debt, correct?
100%. You can't make money if you owe money. Now, certain money you have to owe, most likely. You have to owe a mortgage. You have to owe a car payment. Most people have to owe that until you get more set later in life and you can get those paid off. You should get them paid off if possible. But the one thing that you can't make money on if you owe money is a credit card, because it is just astronomical. Conrad, you and I travel all the time. We see people all the time that they'll sit there and they're reaching their wallet and they don't have enough money to pay for something, whatever that something is. But when they realize they take a card, all of a sudden now they don't just get something. They go, oh, I'm paying for a card. It's like it's free money. Yes. And I'll take that, and I'll take that, and I'll take that. And they all of a sudden they put all this crap on the card that they would have never done if they're paying cash. Now, for one, I like to pay cash because I like to know exactly what I spend. I don't want to bill at the end of the month. I recommend that for almost anybody, because it really helps you regulate how much you spend. But when people realize they can pay with their credit card, it's carte blanche. It's like it's free. Like, okay, yeah, cool. I'll take that, and I'll buy theirs, and I'll buy this, and I'll buy that. It just, you can't make money if you owe money in credit card. You have to get out from under that debt.
I want to encourage anyone listening who is really struggling with credit card debt to do a few things. Number one, you've got to have a plan. If you don't have a plan, this is going to be a mess, and you're going to continue to sort of kick the can. And I know he takes some criticism online, but Dave Ramsey and his Financial Peace University and some of his books, he really does teach you that you don't have to live with credit cards. You can live without credit cards, but it's best practice to get rid of credit cards. While mathematically it may not be the most savvy, the snowball effect does work for a lot of people. I think it's important that you see progress. And the snowball effect just basically means start with your smallest balance first. So let's say you've got 5 or 6 credit cards, and maybe you're feeling stressed and you're maxed out and you're making the minimum payments. But if those balances range from, say, $2,000 to, say, $20,000, hey, let's focus all we can on paying off the $20,000 one. Now, mathematically, someone who's really crunching the numbers, they may say, well, let's look at the one that has the highest interest rate. But Dave Ramsey has basically taught this for years and years because he wants to have people feel like they're accomplishing something. Like, hey, I'm scratching something off the list. There's positive movement and momentum. So that debt snowball of paying off the smallest to the biggest debts, and you feel like you're making progress, that'll allow you to feel like there's a victory and keep you in that plan long haul. I think that's a good strategy. perhaps the worst strategy of all is credit counseling. I think we've touched on this before, but a lot of people who are overwhelmed with their debt, they go sign up for some sort of credit counseling service. And as a result, what it becomes is almost like, at least on the mortgage industry, we viewed it for a long time as if it was almost like they were signing up for bankruptcy. They've basically thrown their hands up and said, hey, our debts have become unmanageable. We're going to hire a third party. Now, those folks make a lot of great promises, but it's been my experience that by and large, all it does is completely obliterate your credit even more and kick the can even further. And a lot of folks who maybe would have previously qualified for help, now they don't, because one of the strategies they deploy is they're going to pay your bills on your behalf on a completely different timetable. So you obliterate your credit and make things worse before they get better. But I don't know how often those stories have a happy ending. I think you can do it on your own. And speaking of housing, John, let's talk a little bit about this. There's a report out that home sellers now outnumber buyers by 530,000. This is the largest gap ever recorded. This is an interesting stat. The idea that another report, John, that said over 71% of real estate agents that are licensed here in America didn't sell a single home over the last 12 months. So there's a lot of people sitting on the sidelines right now. What do you make of this, that home sellers are outnumbering home buyers by more than 500,000?
Demographics is what it is. First, during COVID, a lot of people you front loaded a lot of buying of homes because people weren't going anywhere, and they end up buying homes. The second is the young generation is not buying homes. So the average age of a young buyer of a home about 30 to 35 years ago was 29 years old in 1991, and now it's 40. So now people are waiting 11 extra years to buy a home. The average age of a person buying a second home or a retirement home is 61 now. I mean, you're seeing the movement of demographics going later. Now, this does, these young people, I'm 59 years old, so I'm calling them kids because they're kids to me. But these young people, these kids, a lot of them are getting a lot of flack for living at home. They're not all living at home. Some of them are living together with somebody else. They have a living girlfriend or living boyfriend, whatever that is. Some of them are just young, and are not buying homes for whatever reasons. So all of this is included in this, but a lot of them are simply, they don't want to put that money down toward a home because they're enjoying what they're able to spend their full boat of what they make. It's one of the reasons consumer spending is so high. So one thing is a negative. Home buying is a negative. Now that's huge for the economy because once you buy a home, you buy furniture, you buy TVs, you hire a lawn person, or you buy a lawnmower to do it yourself. Either way, you're putting money in the economy when you're buying a home. But these young people that are not buying homes, they're spending money elsewhere. So you're seeing leisure out there. You're seeing travel out there. All these things are up because of a lack of home buying out there. But what it's doing is it's killing these home sellers because you don't have that young generation feel the need that part of the American way of life and the American dream is to buy a home. Young people don't see it that way anymore.
I do think it's interesting because I think this is a unique opportunity to get a great deal in real estate. I mean, if you just take a look at that stat again, the idea that there are more than 500,000 sellers than there are buyers. I mean, a lot of times on Zillow, the houses that I wind up following, just out of curiosity to see what's going on with the market, I'm seeing pretty major price reductions. You can see the chart here if you're watching over at havemoremoneynow.com, which is our free YouTube. Hit the subscribe button, turn on the notifications bell. But John, I think this represents a unique opportunity. You quoted Warren Buffett last week. I'll do it today. Be greedy when others are fearful. In the long term, it feels like real estate has proven to be one of the more surefire real estate, or investment properties around, or investment vehicles around. And I don't know anybody who long term has lost money on a house. Now, don't get me wrong. I know there's some people who may be in the comments who would chime in and say, well, I bought during peak COVID and I overpaid for my house. Yeah, well, people were hollering that in 2009 too, after the 2008 collapse. But if you take a look at that long tail, if they would have sold in COVID time, and I guess what I'm suggesting is, John, your advice last week about stocks is, hey, you got to know that you've got enough time to sort of hold these properties and allow that appreciation to exist. Well, I think that works not only for GE stock or Google or Walmart, but it works for real estate too. In time, you will outpace it. You will recover. But what you're more apt to do right now, to me, is to get a good deal. Because if and when rates do change, and there's lots of speculation that, hey, when we get a new Fed chair in May, perhaps rates will bottom out. And maybe that'll happen. Maybe it won't. But if it does happen, these home prices are going to go up. If all of the sudden the Trump administration was to change something, say about depreciation, where now instead of having to be a real estate investor in order to get access to that depreciation, if any Tom, Dick, and Harry homeowner could achieve and receive that same depreciation on their taxes, boy, that would turn things around faster and stronger than even interest rates ever could. So I'm saying all that to say, right now, John, I think we have more negotiating power and more buying power than ever. And I know sometimes because I'm in the mortgage business, I get criticized for this, John, but I want your take on it. I really do believe the adage that we started saying a few years ago, hey, marry the house, date the rate. If this is the right house for you, long term, things will level out, rates will improve. It's not like your credit score is not like your social security number. Your social security number never changes. Well, do a lot of other things in our life, like our home address, but our home value, well, that can go up and down quarterly or yearly or whatever it may be, just like your credit score could. It's not a static number. It can move. But historically, if you look at it with a long enough tail, real estate is always on the up. I think there are good deals to be had right now, John, that if interest rates fall through the floor in the next few months, those deals won't be there anymore.
Yeah, I agree. And in the 2009 financial crisis that you brought up, you're right. For the first time, we had subprime and you had derivatives of derivatives. That's where the whole market got in problem and ended up melting up is what it did, because these derivatives of risk, nobody understood these. By the way, this Dodd-Frank bill is the biggest crap I've ever seen come out of Congress. You had the same guys who were watching the chicken coop, then trying to fix the fact that a hen got in the chicken coop afterwards. They didn't see it before. They're not smart enough to see it now. That Dodd-Frank did absolutely nothing to fix what was wrong with the system. And that was, you had some really smart guys figured out ways to have basically derivatives of derivatives. That's what was going on. And it was on the premise that real estate prices nationally would not go down. They had never gone down. They went down, and that blew up the entire model, because it blew up the model, it blew up the derivative, blew up the derivative of the derivative. That's where the whole meltdown happened. That being said, that has only happened that one time in the nation's history where national prices went down. It went down, and it helped cause the financial crisis because so much was levered to it. Real estate has been one of the best investments you can possibly make. Now, there's two things with this, Conrad. One, I believe if you're buying a home, it's not necessarily an investment. It's a home. Now, that's a different mindset. That's a different psychology. Get the home you want. Yes. If you can afford it, get the home you want. It's not an investment. You're not buying this home to say, okay, in 20 years, I'm going to double my money. Now, odds are you probably will, by the way that the real estate prices go up, or you're going to make a lot more money. But the next 20 years, you're going to live in that home. You're going to have kids in that home. You're going to have experiences in that home. That's your home. That's your home that you're living in, and you own it. There's nothing like that in the freaking world. Now, that being said, as far as the investment, they say don't fight the Fed. And what the meaning by that is, don't fight the Fed as far as when interest rates are going one direction or the other. But don't buy stocks that are contrary to interest rates going one way or the other. So if interest rates are going down, don't buy stocks. Don't sell stocks for interest rates are going up. Don't buy stocks. They're saying don't fight the Fed. Something else needs to be created right now. Don't fight President Trump, because President Trump is determined to have rates come down. Now, the Fed is independent, but that doesn't mean that the president doesn't put the Fed chief in power that has the same mindset as the president. So even though it's independent, you put a guy in there that has the same mindset as President Trump. President Trump wants rates to go down. He's the president of the country. He's going to put somebody in power that is having that mindset of leaning to have rates go down. So I think what we're going to see is a lowering rate environment over the next number of years. That is perfect for many things, for the stock market, for the economy, and for housing. It's going to be terrific for housing. And I agree with you. There's no better time to buy than right now as far as historically. You saw the incredible rise. What you're seeing also, Conrad, a lot of, and you don't see this if you're in Massachusetts, you're just screwed, okay? Because you got a high tax state. There's not much you can do about it. But people that are moving, money's fungible. People that are moving, Texas real estate prices have gone through the roof. Florida real estate prices have gone through the roof. They're starting to come down now because you're starting to see people, the money starting to subside a little bit, and most of the money that's gone in is already in. You're not seeing a lot more go in because of what's going on demographically. And I think now is a good time to buy. I think if you buy a home right now, you'll be very happy with it in the next 20 years.
I totally agree. And you take a look at where real estate prices were 10 years ago, 20 years ago, and you look at where they are now, you want to get in early. I mean, I think that is our pro tip for almost all of our investment strategies. And I will say, while I agree with John that, hey, it is a home, it's not necessarily an investment. Now, he's saying that as someone who's going to encourage you to have an investment portfolio that you can actually liquidate and pull out. And I think that's tremendous. But I would suggest that the largest portion of the millionaires who live here in America, the biggest piece of their portfolio is their home equity. Because once you own that home free and clear, I think that's the real definition of the American dream. Like when you can wake up and I don't have to pay for anything. I don't have to go to work today. That freedom, that peace of mind of knowing, hey, the rent's due on the 1st. When you can divorce yourself from that, it's a real win. I do want to say, I don't think a lot of people think about mortgages the right way all the time. And I realize I'm the mortgage guy, but here's a little pro tip for you. The word mortgage is actually Latin for pledge until death. It was designed by bankers to get 29% of your gross monthly income every month until you die. So what they've done is they've convinced people to say, come into the bank and ask, hey, what's the most I qualify for? Well, said differently, here's what that sounds like. Hey, can you make me house poor? I need to be really dependent on this bank. And I think a lot of people who are listening to this have at least heard debt to income ratio, but maybe they don't know what that means. I just want to briefly explain. We take a look at your income versus all of your debts. Just, hey, what's coming in and what's going out? And we apply a mathematical formula to it to show us what your housing ratio is. And ideally, most underwriters want that to be 29% of your gross monthly income. So if you make $10,000 a month, we don't want your house payment to be more than $2,900 a month. But on a debt to income ratio, Fannie and Freddie don't want to see you go past 50%. Now, the best practice would be 41%. But even on that $10,000 example, think about that. Fannie and Freddie are like, hey, if you want to spend half of your gross income on your bills that we can see, which means not your credit card bill and not your utilities or not your insurance, but just your credit card bills and your car payments and your house payment, they want that to be around 50% or less. What did they forget in that scenario? Taxes. You don't get 100% of your check. So what you're accidentally doing is becoming house poor and dependent on the bank. And then the bank says, hey, don't worry about mailing us a check. We'll just draft it out of your account. And then we as homeowners, we get used to living without that money. And it's almost impossible for us to imagine a world where we have that house payment money back. The true American dream is for you to own that house free and clear. And I want to challenge you, if you're thinking about buying a house in the new year, don't fall into the trap. Don't go in and meet with a banker or a mortgage guy like myself and say, hey, what's the most I qualify for? Don't even offer that up. Instead, tell them this: I want my new house payment to be no more than blank. They'll be able to reverse engineer you into the exact same sales price. Here's what they're going to need to know. They're going to need two things from you. What do you want your monthly payment to be? And what amount down are you comfortable with? If you know those two things, man, now you're set up for success. I don't mean set up for success as far as becoming qualified and approved for the loan. I mean for peace of mind on the other side. A lot of people are overwhelmed when they start house shopping. They don't know what price range should I be looking at. How many bedrooms, how many baths. Don't let that be your North Star. You decide. Don't let that be dictated to you. You know what payment you'd be comfortable with. If that payment is $2,000 a month, say that. If it's $5,000 a month, say that. I want my new house payment to be no more than $5,000 a month. That way you'll get the house that you and your wife really like at the payment that you really love. If you do it the other way and you let the old banker say, here's the most you qualify for, and then you let your bride go look at houses that qualify for that, and then you sit down and get sticker shock on a payment, buddy, you're disappointing somebody no matter what you do. So start with the end in mind. I want my new house payment to be no more than blank. That would be my best practice of the week when it comes to housing, John, because I think if you're comfortable with the payments long term, you're going to be great.
Yeah, and Conrad, another thing that's happening right now in the country, a lot of seniors are taking out second mortgages because their houses are paid for. And there's a reason for this. Healthcare costs have gone through the freaking roof. Yep. And so a lot of these seniors have their homes paid for. So they're taking out a second mortgage on the home that's already paid for to pay for healthcare costs and other things they need as costs have gone up later in their life. Now, people look at this and say, oh, they shouldn't be taking on extra debt. You dumbass. I mean, thank God they've got something. Thank God they got something. They don't have to move out of their homes. And so what a lot of these seniors are doing, and you're seeing it all across the country, it is a massive, massive trend right now because healthcare costs have gone up so freaking much in this country that a lot of these seniors are taking out second mortgages on their homes that are already paid for, very, very low interest rates, and they're able to live comfortably in their retirement years. Are they taking on extra debt? Absolutely. Thank God they have it. Because otherwise they'd have to sell their homes, they'd have to downsize, they'd have to move into a assisted living or move into a smaller home or not a home they've lived in their entire life. That's another reason for buying your home because you have so many more options that you have with the bank, with so many different things when you own that home free and clear.
I encourage people, let's keep after it and start thinking about what does the end of your loan look like? How old are you going to be when you pay your house off? I don't think a lot of people really think about that. But it's not
Conrad, I don't mean to cut you off, but is the greatest thing in the world, man. I've been around the mid '90s or late '90s or something. We had a thing called the Brawl for All. It was a tournament in the WWE, and I ended up making a total of $40,000 because I won 3 fights and I lost the final against a guy named Bart Gunn who I ran into a left hook. I shouldn't have fought sober. I think was the problem. I never fought sober with gloves on. I think that was the issue. But I got $40,000. And I went down and I bought my first home, $84,600. It was 139 Penny Lane, Athens, Texas, 75751. Love that place. And for put down over almost half the amount for the home. I remember not too many years later, because I had such a small mortgage, $44,600 was my whole mortgage for this nice little 2,000 square foot house and about an acre of land. And I remember paying that off several years later because I was doing okay and I was putting money toward that. There's no greater feeling in the world than paying off your home. I mean, it's just, I remember going to the bank. I was so excited. I'd gotten a pay-per-view check or something. And again, it's not much money. It wasn't like I'm talking about $1 million home. I had a $44,600 mortgage, my first mortgage. And I got a pay-per-view check several years later for a few $1,000s, whatever it was. I went down and paid off that home. Man, that was the greatest feeling. I remember to this day walking out of that banker's office. I was so freaking happy. I had no debt. I haven't had any debt sitting. There's nothing like that. And there's nothing like planning for that. And it's possible. You take out a 20-year loan, you're going to pay that thing off in 20 years. Okay. You can pay it off early. You can do a lot of things like I did because it wasn't a very big loan. But paying that loan off when you pay off that house, buddy, there ain't nothing in the world that gives you a feeling like that of accomplishment.
Peace of mind is the word I would use to describe it. The idea that you're good to go. You don't have to worry about your landlord saying, "Hey, we're raising the rent," or "We got to have it."
An old guy, I keep cutting you off, Conrad. I'm sorry. Old Black Bart, his old wrestler, he had his glasses halfway down his nose. He puts his glasses up like this. He'd spit in a trash can. And he goes, "You could pump gas if you own your home and pay your bills." And nowadays you don't pump gas anymore except for up north in some places, but you can if you own your home. You got a lot of options out there.
I want to encourage you, think about that when you're getting that new home loan in 2026. What will the end of your loan look like? Meaning, how old are you now and how old are you how old do you want to be when you retire? Most people, when they're buying a house, they just think about, hey, what's my down payment? What's my monthly payment? Yes, that's important. But what does the end look like? It's not one size fits all. If you're 30 years old today and you sign up for a 30-year loan, can you even imagine what your life looks like when you're 60? And what life changes may come your way during that time, not just for you, but from your family. Are you going to have kids? Are they going to drive cars? Are they going to go to college? How are you going to pay for all of that? So I know a lot of first-time home buyers, they almost never look at a 15-year loan. I would almost challenge you specifically, if you're a first-time home buyer, why don't you look at a 15-year loan? No, it may not be as nice of a house as you wanted for that monthly payment, But boy, the peace of mind of knowing that if you buy at 30, you're going to be debt free at 45. Well, if you plan to retire at 65, now you've got 20 years where instead of paying the bank, now you get to pay yourself for 20 years. That compound interest with some of these investing strategies you're hearing from John, boy, that can make all the difference in the world. And I just want to throw that out there to you. I think that is a best practice everyone could learn from. What does the end of my loan look like? Hey, let's talk a little bit about MrBeast. I don't know if you saw this, but I guess he took to Twitter earlier this week and announced that they have acquired the financial services app Step. He says, nobody told me about investing and building credit or managing money when I was growing up. That's exactly why we're joining forces with Step. I want to give millions of young people the financial foundation I never had. Lots to share soon. Now, of course, we don't know exactly what this is going to look like with MrBeast, but we know without question, I almost feel it's not a fair term for him. He's the biggest influencer online, but I mean, he's probably the biggest celebrity online. I mean, hundreds of millions of subscribers. His company is worth billions of dollars at this point. But supposedly this was a $900 million company. Supposedly the deal's worth north of $1 billion. But I like the idea of a young person trying to teach young people about financial responsibility while they're still in school. That could be huge.
Yeah, it could be huge. And I want to bring up something, for people, starting a business. I work for a guy, Mark Masters. He built a lot of the talk radio network that's out there. So if you want to blame somebody, blame Mark. Mark was actually a really good man and lived out in Medford, Oregon. But he created Rush Limbaugh. He created helped create Hannity. He built the Fox radio, mainly conservative. He also did Mancow. He did so much more. But he really had he was at the forefront. He was a pioneer of developing talk radio. And what his idea was, he never wanted to develop talk radio. He wanted to develop a platform to build business. So that's what MrBeast is doing. MrBeast has developed this entire platform. Now, how do you monetize that? Now, that guy is killing it, by the way, absolutely killing it. But what's the best way to monetize it? Now, you can get your views, you can get your revenue from your streaming and all that stuff, or you can do something like get this company Step and use your platform to push this. And now all of a sudden you have a multiplier effect with this. That's what I want to encourage people out there. If you're starting a business, you got to worry about how you're going to promote it. And a lot of times people decide they want to start something, a podcast, a network, something, because they want to use it to promote business. That's what MrBeast is doing. This model is as old as the internet, which is not that old, but it's as old as the internet being done. He just does it better than anybody else. He's got this massive platform, and now he's going to put this product on top of this platform and use this platform to build this company. I think it's absolutely brilliant what he's doing. And I think what he's doing with Step, I've read through it today. There's not just a ton of details, but it's for young people. Young people need to know about finance. Conrad, we do a rotten job in this country of educating young kids. See, I would have always thought that the NBA, this one and done BS that they do, I think that is the dumbest thing ever. They go to college for a fall. They don't even go to class in the spring. I think what these young kids should do, you should put them in the G League or whatever they call the Nike League that they have out there. Make them learn by classes finance. Make them learn how to deal with agents. Make them learn things that they need to learn. They don't need to go to a liberal arts class and learn something about Shakespeare or somebody else or whatever else. These colleges give kids worthless stuff that they stick in their head. They don't do anything to help these kids get into life. And that is, how do you deal with a mortgage? How do you invest? What do you invest in? How do you handle your money? How do you negotiate deals? None of that's being done. What MrBeast is doing here is he's putting a platform together that's going to do that. And it's going to be better than all our colleges because our kids like MrBeast and they're going to follow this program. I think it's going to do incredible things. And for MrBeast, I think it'll make him even more wealthy.
Can't wait to see what's next there. Really looking forward to that. I do want to talk about, while we agree that's a great idea, maybe one of the worst ideas. This was news in the last week or so. You can now use buy now, pay later for your rent. Can't believe that's a real thing. But there's a new option for renters where you can pay a fee or a monthly subscription. And if you miss a payment, interest rates go way up. I mean, we've seen some of this online before. I can't believe that last year they started offering this on like meal service delivery, like on DoorDash and things like that, where you could finance that. Guys, financing your rent, that's got to be near the top of the list for the book of bad ideas, don't you think, John?
Oh my God, man! Why don't we just legalize loan sharks? This is crap. This is pure garbage. I mean, it sounds great, but until you look at it and you realize, what in the hell why would anybody do this? Yeah, this is written with bad idea all over it. I mean, there's some people out there that are putting stuff together. They dress it up just a little bit, put a little stuff around the periphery and say, oh, this is such a great idea. And they get a couple people to endorse it for a little bit of money because those people have absolutely no integrity and they'll endorse anything. And you come up with products like this.
It's not all bad news. We saw as we're recording this morning, the jobs report came out. It looks like we added 130,000 new jobs in the month of January. So that's a big deal. And of course, we also saw that the Dow hit the 50,000 milestone. John, you've been watching this for a long time. Did that feel like a banner day? Was it high fives all around in the Layfield household?
Holy cow. Yeah. I mean, the portfolios are just going through the freaking roof. And Conrad, I said at the beginning of the show, we're in a seismic shift. I mean, an absolute seismic shift. People don't know about how the deglobalization is going to work under President Trump. You know, there's some things out there that could be some potential headwinds that are coming out there. But the tailwind is so freaking big with this AI. These AI data centers, these things are going to change the freaking world. We're in a shift that we're going to see in our lifetime that people will talk about for the next 1,000 years. That's how big this AI is. And we're in an incredible time right now with this. You know, there's a lot of things going on right now. You know, I invested in uranium during the Biden administration because, again, you buy the things that are not in favor is the way I like to invest because you get good deals on them. Same way you talk about housing. You know, the Democrats did not like, especially after the nuclear meltdown in Tokyo, did not like nuclear. So you didn't like uranium. You were having to get spot uranium, not even out of mines, to try to fulfill the uranium obligation of nuclear power plants at the time in the world. That investment has gone up 4 or 5x. Now the Trump administration is very much behind the nuclear and uranium, but they're against renewable. Renewables are here to stay. Wind power is here to stay. Solar is here to stay. It may morph into something else. You're going to see some opportunities in the next couple of years because of the political headwinds against it, of buying something like the renewable energies and what goes with it. Maybe that's copper, that wiring that goes with it. Maybe that's different things that goes with it to build the picks and shovels, as they say, not necessarily buy the gold, buy the picks and shovels. And you're going to see some pretty good opportunities in renewable energy in the next few years.
Hey, you mentioned gold. I wanted to bring this up. I don't know that you saw this, but JP Morgan has changed their suggestion about what gold could be this year. They're saying now it could be $6,300 an ounce. That is their prediction. And if you take a look at the gold charts, man, it feels like not that long ago it was like under $1,200. Yeah. And now here it is. They're suggesting over 6,300. As we're speaking this morning, it's just over $5,000 an ounce. What's your read on this? You know, this feels, I don't know, this is the antithesis of Bitcoin. This is the way it all used to be. Is gold still a smart buy? Is there still meat on the bone at 5,000? Do you think? Would you give gold a buy right now, John?
JP Morgan says it's 20% up from here, and that's a pretty good return for a year. You know, Warren Buffett, we quoted last week, 23% return was his return per year. He became the richest man in the world off a 23% return. So that's what a 20% return does for you. That's an incredible return. That's hard to do. That's double what the S&P does by average with dividends and everything every single year. That's a terrific return. Gold is a safe haven. So is silver. And so you see all this problem in the world right now. I mean, you just had the El Paso airport shut down. I don't know if that means we're about to bomb a cartel or something. They got problems going on in Iran, which where a lot of oil there is from. A real problem there could be a Strait of Hormuz problem, which is where most of the oil, portion of the world's oil goes through every single day. gold is a safe haven. It always has been, and it still is. That's the difference between that and Bitcoin right now. Bitcoin is not a safe haven. Bitcoin is a store of value. That does not mean that it's worthless or worth any less. It's just a different way that people get into Bitcoin as compared to gold.
It'll be interesting to see what happens with Bitcoin and gold. I know that people on either side have really strong opinions. I think overall we're going to be in tune for a pretty great 2026. All right, each and every week here on Have More Money Now, we're going to throw you guys the keys to the show and let you ask John anything. So let's get started with a great question here from Adam Garlow, who wants to know, John, what is your opinion on fractional shares?
I love them. And the reason is it's like this dollar cost averaging. It doesn't matter what you buy in the share. Say the share is, you had some companies didn't split a lot of their shares, and a share gets up to $1,000, and you can't either afford or don't want to spend $1,000. You can spend $100. You can spend $500, $250, $50, whatever that is. If you have the ability to get into it, you're investing in that company. You don't have to buy a share. There's no secret number out there of saying, okay, I want to invest in Amazon, and say Amazon's share price was trading in the thousands of dollars or whatever. Fictionally, let's say that's what it was, and you couldn't do it. It's prohibitive for you. But if you can get into fractional shares, then it's easy because you can invest in what you want. That's one good things about ETFs. That's one good things about dollar cost averaging with a lot of these companies. It doesn't matter the amount of share count you have. It matters how much money you have that you can put into it. And if the $100 that you can invest, it gets you 10 shares, so what? That's good. If it gets you a tenth of a share, so what? You still invested $100 into a company that you wanted. And if that company goes up 10% the next year, you made 10% on your money. It doesn't matter about the share count or anything else. It matters how much money you can put into it. So I think it's a terrific idea.
Quarter Ton has a great question. He says, other than a savings account that holds savings with varying low percentage gains over time, what secondary account options would you recommend exploring that differ from a standard savings account format?
There are so many things out there right now that are making 4% and 5%. That's huge. I mean, huge. That you can just simply Google. And the main thing, though, is that I would insist on make sure it's FDIC insured. Odds are that nothing's going to ever happen that you have to have that FDIC insurance. Odds are that'll never happen probably in our lifetime. But because of that FDIC insurance, it adds an extra layer of security and also the confidence that you have with the company that has done all the things they need. So I would just insist, whatever you do, that it's FDIC insured. But just, man, there's so many things out there. Shop around. You can get 4% and 5% rates right now all over. Good banks, good solid banks that are FDIC insured and have a pretty good return on your money that's safe.
Buddy Heath, I think, is looking for the get rich quick scheme. He wants to know, for the average person that doesn't have that much money to invest, what is the next Tesla or Amazon stock out there? Boy, John, if you have that information, you could make a fortune.
Buddy, I wish I was smart enough to answer this, but I'm not. I wish I was. If you find an answer, I'd like you to text me and tell me, because that's what everybody's looking for. That and no offense, that's a terrific question. There are a lot of things you can do to invest in, say, AI. So there's AIQ, which is the ETF. There's also ARK, which is run by Kathy Wood. She does a great job of managing actively this ETF of all of the tech stocks out there, so you don't have to. I would get into something like that. The problem we have with startup companies is there's some risk involved. And if you get a company like Amazon, you also get Pet Foods or Us or whatever it was back in the internet days of, the companies that go bankrupt as well. I don't want to take that risk of a zero-sum return. Either I make a ton of money or I make zero. I don't like that option. I sports bet a lot, but I know what I'm doing with that. I say I know what I'm doing. I know what the risks are with that. I don't want to do that with my financial my portfolio. I want to have some idea that it's going to be a pretty good company the next 10 years.
CB says, question, I have a traditional IRA that I started after being laid off years ago. Whenever I receive a payout on a retirement plan after changing employers, I roll it into there. Would it be better to convert it to a Roth IRA now or stay traditional? I'm almost 43 and still have a ways to go in the working world.
First of all, congratulations. Terrific that you're investing and you're doing apparently very well right now. And that's wonderful. You're going to be very well set up when you're 60 or 65, whenever you choose to retire. And I hope you get to retire early. And I hope your returns are fantastic. There's a couple different things to look at here because there's different traditional IRAs and there are different Roth IRAs. Generally, if you switch from a traditional to a Roth, you have to pay taxes. So the idea is if you think that your tax rate is going to be lower now than it is when you retire, you would switch. For most people, that's not the case because once you retire, you're not making as much income. It's lower. So you don't necessarily want to switch because the Roth IRA, when you switch it like that, for most traditional and Roth IRAs, you have to pay taxes immediately. Then it grows tax deferred and you don't have to pay taxes. And some you don't have to pay taxes at all when you start taking distributions. So simply look at it. Look at what you have to pay tax-wise. Look at when you pay your taxes. Do you pay is this goes in pre-tax money and does it grow tax-free? That's a complete difference. There's a lot of traditional and Roth IRAs, different ones. Just be sure and check it because most of the time, if you're paying taxes that you think are higher now, which most people are when they're working, you don't want to do that switch. But the key thing is to look because there's different ones.
Quarter Ton says everyone is on their phones for some portion of the day for various reasons. Are there apps either of you would recommend downloading and learning to have it become part of a daily or weekly habit for trading, investing, crypto, betting, obtaining a certification, etc.? What are your go-to financial apps, John?
Oh my God, I got so many of them. I love them, and I don't know how many subscriptions I have. I got to figure it up sometime. I got 1 million freaking subscriptions, like most everybody that that doesn't manage it very well. But I love them all. I do a lot of reading apps. So I have The Economist, I have Wall Street Journal, I have the Financial Times, I have the New York Post, just because it's fun reading. But I read those 4 things. Now, Economist is a weekly, so I don't always read that daily, but I read those other 3 pretty much daily. But I've also got just tons of other apps that are information apps. Sportsline, when you talk about betting, Sportsline is a terrific app. There's also the Action app that of sports betting, but Sportsline, to me, they've got some really good experts on there that break down the games. They also have pretty good sims. When I say sims, simulations that go there. Dimers is very good for sports betting. Gives you what a sim would be basically on a game. That doesn't. It's not a reason to bet or not to bet, but it's one of the tools that you would use to bet. But most of the apps I have are just reading apps. I don't have I'll look at Yahoo Finance occasionally, but that's just kind of do a little research. Most of it is just reading from newspapers and magazines.
Rick says, I have a full-time job and a side business as a DJ. I'd like to grow my side business to become a full-time gig. I have the idea to roll in marketing and PR, which is my day job, to the customers I currently provide services to as a DJ. Any advice on managing and positioning myself to grow? That's a great question, John. What would your best practice be for somebody who wanted to take their part-time hustle and make it a full-time thing?
I've seen a lot of people do this, and so have you, Conrad. This would be something that you would be very expert at answering yourself, and more so than me, I would think. But it's very simple to me. You figure out a way to ramp it up without risking the farm, as they say. Do bigger and bigger events, and do a big event somewhere in here. Now, not where you're gonna, if you lose it, you lose your house, or not something that big. But you want to get to where this is your full-time gig. To do that, you've got to ramp up at some point. And in ramping up at some point, since you're doing these events, get bigger and bigger events. And then roll the dice with a big one. Not where you're going to lose a ton of money, but roll the dice with a big one where it takes a lot of work. And you can start to figure out, is this something that you're proficient enough that you can make a living at? Or does the local economy where you're at, also very important, does it support you doing something like this? And then all of a sudden you might find yourself doing your dream job. But if not, you can figure out a way without risking too much financially. Is this a good idea to try to migrate into this?
Yeah, my advice would be, hey, let's grow as we can when we can. I would encourage you, just as John has been preaching from day one here, do not go into debt. Don't go out and obligate yourself to new debt in order to fund this new business. grow as you can. I'll never forget our first mortgage office, I think was 1,100 square feet when I first started my own thing. And man, we had people sitting on top of people. And my next space was over 5,000 square feet. But at that point, I had outgrown my business. We were bursting at the seams. We moved when it was necessary. So I would be mindful to all of my overhead and my expenses. And I guess the next big thing I would challenge you to do as a new entrepreneur is don't view the business's money as your money. See, a lot of people who run small businesses who start to operate with a scarcity mindset as opposed to an abundance mentality when they're trying to grow. And they'll think, well, everything that's in the business, well, that's my money too. And they start to make decisions that make their personal life easier, but not necessarily the ones that best take care of the business. If you take care of the business will take care of you. So my advice would be keep that overhead low, keep those expenses low, stack up as much cash as you can, and find a way, if you can, to bridge the two together. And it doesn't have to make sense. Heck, I found a way to put mortgages and nostalgia wrestling podcasts together. You can do this too. You've just got to be strategic about it. And I think you're smart in thinking that one can serve as a way to sort of advertise to the other. That's what we're doing, even with this podcast and what I do with mortgages. That's what MrBeast is going to do with his YouTube and Step. You can do that too. Just find a way to pull those two audiences together. Quarter Ton has a question for us.
Hey, Conrad, if I can right quick, just a quick answer also. So somebody asked about sports betting. I want to give a quick thing about sports betting as far as money. We talk about money a lot, about different things. To me, sports betting, Billy Walters is arguably the greatest gambler of all time. Tremendous gambler. People talk with him. He's still alive. Talks about it in reverential terms. And he insists that you take no more than, say, a 2% of your portfolio of your balance. So to guys that are sports betting, because I was asked about that, the way to manage money, and you manage money in a lot of different ways like this. Let's say you have $1,000 or $2,000. Say $1,000 because it's easier. And if you take 2% of that for your bets, that's a $20 bet. Okay, so that's the bet that you would make. Now, is that you want to bet 100? Sorry, that you're outside of the norms of what you're doing, unless you have, say, a $5,000, which would be a 20% bet of that. But you have, say, a 2% bet, and it's constantly fluctuating. So if you have, say, $1,000 and you're betting a $20 bet, and you lose 5 bets, and now it's $900. Your bet is now $18. That way you're always staying within that 2% range. That's how you sports bet, and you never have to worry about how much money you're winning or losing. You have a certain finite amount. And if you go up, it's just the opposite. So instead of $20, if you win $100, you win 5 different bets. Now you're betting $22 because that's 2% of that bet. But that's how you manage your bankroll in sports betting. That's how pro sports bettors manage it. They don't just say, I have $1,000. I'm going to bet $250 on this bet. Now, if that's what you want to do and that's your hobby, do it. It just, life's too short to to be cheaper. If you can afford it, bet it. But if you want to do it long term, the way to do it is through some type of bankroll management, and that's the simple way to do it.
One last question here. Quarter Ton says, what are always the talks of if start it over? My bad. One last question here, John, from Quarter Ton. There are always the talks of if only when it comes to stocks that just took off over time and people look back on Coca-Cola, Apple, Google, etc. You don't need to name a specific stock, but what area would you focus on from a stock standpoint, from a long-term future view? John, it feels like everybody right now is talking AI. Is that still the answer, or is there a different answer for you?
No, 100%. AI is the future. But also, Conrad, a lot of things are out there that have to be serviced. So you look at things like Walmart. I love Walmart. I own Walmart. I own Amazon also. I think both are fantastic companies. I think Walmart's actually better positioned for its online business because it has distribution centers, Walmart centers all over the country that it does not have to build. They're already there. I mean, their infrastructure is just absolutely amazing. But take a step down from Walmart. So go to, like, say, Dollar General. Most people that shop at say, dollar stores walk to those stores. So you have a real need here in the country. These people are not ordering online, and these people are not going to be affected very much by AI. You know, a lot of them are lower income, but they still have to have some place to buy their stuff and some place to go. So just because AI is this big holy grail out there, and it really is, does not mean that there aren't tons of things that are just old-fashioned brick and mortar that still have to service so much of our population. There's a lot of things out there. The trends, it's all AI. If they build these data centers in space like they're talking about, like Musk is talking about, and that changes the game. I mean, these things are the world's going to change with AI. And think about, say, look at the trend of cars. It's not going to happen in the next 5 to 10 years. It'll happen in the next 20 years. People are not going to be buying cars. You live in a city, you're not going to have cars parked along the street because the cars are going to be all autonomous. So you're going to have a car. If you have one, it's going to be somewhere else in a garage. You're going to call it, and on your phone, it'll come pick you up and take you to wherever. You may share that car with your neighbors, or you may just say, you know what, I'm just going to have a ride share. You're not going to have as many car sales going forward as you're going to have now, because people aren't going to need so many different cars, because when cars are in a downtime, they're going to be used by somebody else in the family because you're going to be able to call them. And so trends are all over the map right now. There's never been an economic jump, say like from the stagecoach to the train. Say, what are we going to do with all these stagecoach jobs? The economy boomed. It boomed with the airplane, with the car, with so many different things. You've never had a huge jump like something like AI that didn't create a lot of jobs. People talk about this is going to kill a bunch of jobs. It is. What it's going to create, there's never been something that's changed the whole world that has not added to the economy. I think AI is going to be the same.
Well, we're learning a lot. We're having a lot of fun. We hope you are too. We hope you'll tell a friend to hit the subscribe button and turn on the notifications bell. Our show is totally free, and it's available on YouTube at HaveMoreMoneyNow.com. Don't get it twisted. That's just our free YouTube. We just want to make it fast and easy for you to find us. The name of our show is Have More Money Now because that was the name of John's best-selling book that he wrote years ago, his first financial book, probably his first of many. And we challenged you guys last week to show us that you had subscribed to our YouTube, and we were going to select one lucky winner to get an autographed copy of John's book. And I'm happy to say that Shayla D at SDaniels8415, you're the winner, and that autographed copy of Have More Money Now will be coming your way. This was so fun. We'll do it again. We're going to give away a second copy of the book. And the way to do this is to just go hit the subscribe button right now at HaveMoreMoney.com and then post a screen grab. Just show us with a screenshot that you hit the subscribe button, that you're subscribed to our YouTube, Have More Money Now. Be sure to tweet it to us at Have More Show. As long as we're tagged there and you're showing us that you've subscribed, you're automatically entered. We're going to keep giving these books away and have some more swag in the coming weeks. But we appreciate you guys helping us be our foot soldiers, getting the word out there. If you know someone who's serious about getting out of debt or investing or securing their financial future, maybe it was on their, list of New Year's resolutions, lose weight and get in better shape and save some money. Well, hey, we can help you there. With at least one of those. Go hit the subscribe button, HaveMoreMoneyNow.com. John, this was a blast. I love just picking your brain and talk about what's next. I'm excited to see what we can do next week here on Have More Money Now.
Yeah, I'm excited too. I've been looking about a lot of stocks, especially with sports betting because of the poly market that's out there. I'd like to, talk about some of it next week, when I have a little more time to do some research and stuff. There's a lot of great things that are going on, not just AI in the world out there. AI is changing everything, but there's a lot of stuff going on that's really cool to talk about.
It's going to be a lot of fun. Hit the subscribe button, tell a friend, and we'll see you next Thursday, each and every Thursday, right here on Have More Money Now.